Everyone says just invest in index funds and you'll be fine. Just buy the S&P 500, hold for decades, and everything will work out. But what if that's not enough? Don't get me wrong, index funds are one of the best financial inventions ever created. They're simple, low cost, and incredibly effective for most people. You get instant diversification, you reduce risk, you don't have to pick stocks or time the market, and for many people, that's already a huge step forward. But here's the uncomfortable truth no one talks about enough. Index funds are designed to give you average results. Not bad results, not terrible results, just average. And average might be fine if your goal is to retire at 65 and maintain a comfortable lifestyle. But what if you want more than that? What if you want financial freedom earlier? What if you want to build real wealth? What if you don't just want to survive financially, but actually get ahead? That's where things start to change. Because when you invest in an index fund, you're not investing in the best companies. You're investing in all of them. The winners and the losers, the undervalued and the extremely overvalued. You're buying the entire market, including its mistakes. Think about that for a second. If a bubble forms in the market, you're fully exposed to it. If certain companies become massively overhyped and overpriced, you still own them. You don't get to choose. You just follow. And that leads to the second problem. You can't beat the market because you are the market. No matter how hard you try, your returns will always be close to the average. Minus inflation, minus taxes, minus time. And over the long run, that could make a huge difference. Now again, that's not necessarily bad. But let's be honest, nobody builds extraordinary wealth by being average. Real wealth is usually built differently. It comes from concentration, putting more capital into your best ideas. It comes from asymmetrical opportunities, where the upside is much bigger than the downside. And it comes from making active decisions, not just following a system blindly. Think about how people actually get rich. They start businesses. They invest early in high-growth companies. They buy assets that outperform the market. They take calculated risks. Now, that doesn't mean you should go all in on risky bets or start gambling in the stock market. That's not the point. The point is, if your entire strategy is just buy index funds and wait, you might be limiting your potential without even realizing it. Because you're playing not to lose instead of playing to win. And those are two very different games. The smartest approach is usually a combination. Use index funds as your foundation, your safety net. They give you stability, they protect you from making big mistakes, and they ensure you're at least keeping up with the market. But then, on top of that, you build additional layers. Maybe you allocate a portion of your capital to higher conviction investments. Maybe you learn how to analyze businesses. Maybe you invest in skills or start your own project. Maybe you explore real estate or other asset classes. The goal is to create upside, not just stability. Because stability alone doesn't create wealth, it preserves it, and there's a big difference. At the end of the day, index funds are a tool, a powerful one, a useful one, but they're not a complete strategy for everyone. So before you blindly follow the just buy index funds advice, ask yourself one simple question. What am I actually trying to achieve? Am I investing just to be safe, or am I investing to build something meaningful? Because if you want to truly get ahead, you might need to go beyond the average. And that starts with thinking differently.
You can stand under my umbrella.